traders, and welcome back to today's daily market update. On Tuesday, the oil prices dropped below $71 a barrel, erasing all the gains made this year. This decline is mainly due to the concerns about weaker demands in key Asian countries and increased oil production by the OPEC+. The energy experts says that fears about falling demands are keeping the oil prices low. Economic slowdowns in major Asian countries are also affecting other industrial commodities like copper. Last week, Goldman Sachs lowered its price oil forecast, citing worries about the recession in these Asian economies and more U.S. oil supplies. Even though rising tensions between Israel and Iran have led some traders to bet on potential supply disruptions, most traders and OPEC countries think that the geopolitical tensions are the only thing that could push the oil prices above $100. For now, oil prices are trending down, which is good for drivers and the Fed Reserve, but not great for investors in major oil companies. Next, for the gold, the prices fell on Tuesday as traders came back from the market after the Labor Day holiday in the U.S. The U.S. ISM manufacturing PMI for August was below 50, showing that manufacturing is slowing down. However, the employment part of the report improved a little bit, easing some concerns among the Fed Reserve officials about the labor market. This led traders to buy the dollar. Despite this, the gold prices bounced back after hitting a low of $2,473. The market expects a 65% chance that the Fed will cut interest rates by 0.25% in September, which is a challenge for the dollar but could be positive for gold. Some traders are even anticipating a 0.50% rate cuts. Analysts at Commerzbank said that if the U.S. job data is weak, concerns about the recession and more rate cuts could boost the gold prices further. For the dollar index, one set of data isn't enough to show a trend, and two sets still might not be enough. But if Friday's job report shows another weak results, it could signal bigger problems. The risks are high right now. Good data probably won't change plans for this September rate cuts or future cuts, especially if the inflation stays weak. However, the weak data might suggest the U.S. economy is in trouble and could lead to a sharp rate cuts. We expect the U.S. job growth to be 175,000 in August, the unemployment rate to drop to 4.2%, and the wages to rise 0.3% from previous month. We think that the July jobs number were affected by the Hurricane Beryl, but demand is still strong. If the unemployment rate rises to 4.4% and the job growth is only around 100,000 or less, a 0.50% rate cuts in September could be considered. Jerome Powell has indicated that he might support more aggressive rate cuts if needed, giving Fed the flexibility to act. And that is all for today. Thank you for watching.